financial with ratios. So this is out of the TUT letter. So let's just go through it. You see the TUT letter's got a whole 2 pages on what you're supposed to do. So what it basically says is, this is the 4861 TUT letter. If you have a look, guys, in the second paragraph down after the introduction, it says to you, financial information is analyzed in part to assess both business and financial risk. This includes 1, the calculation and comparison of ratios with other calculations within the entity over time. So number 1, you're going to need to know how to calculate. 2, comparison of ratios and other calculations of the entity with industry or similar ratios. So I have a comparison to last year, or I have a comparison through to the industry. And 3, the discussion of and conclusion on the calculated ratios. So effectively, you're required to be able to do 3 things. Number 1, calculate it. Number 2, compare it to something and talk intelligently when you compare it to something. Are you guys comfortable with that? And 3, you need to discuss it in some detail. Now, guys, if you sit there and say this is good, or this is bad, or this is better, or this is worse, are you going to get your marks for these questions? You need to discuss in a little bit more detail. Does everybody understand where I'm coming from? Okay. So what I've basically given to you is this, guys. There's a nice spreadsheet, and it's got all of the formulas you need to learn for it. And I'm not going through this in class, but what I will do is I will go through each of the individual sections with you, and I will actually discuss pragmatically how to approach each of the individual sections. So I'm not going to sit here and actually teach you each and every single ratio and do something along those lines. Now, what the actual study guide tells you to do is this. So let's just go back to the study guide. Okay. So it's there. So what they ask you to do, guys, is they ask you for activity 8.1.1. They say work comprehensively through the financial analysis example 8.3.4.3 in managerial finance. Everybody comfortable? So they ask you to do that, guys. So for Funky Junk itself, guys, this example, I'll post it on the classroom, and there'll be somebody, you can go through it itself. The actual notes themselves, guys, you'll see that they're notes, this set of notes here. If you look at the 2017 class, guys, and you want to go through this spreadsheet, okay, and you want to go through it step by step by step, everything in the notes that I've handed out. So I've handed out ratio notes to you. There are videos inside that class in 2017 where we go through the notes step by step by step by step. And I'm not going to do that either if you want to do it. I just find with ratios, it's better to actually just go practically through it, but it is there as a resource for you. I'd rather do examples with you and teach you how to do it pragmatically. Are you guys comfortable with this? Because normally it's not a process with that you don't know how to calculate something, it's that you don't know how to discuss it properly. Is that right? Would you like me to put that on the current full-time class as well? Okay, so there are 3 videos, and if you want to go through the notes, it just basically, those 3 videos run about 2.5 hours, and they practically go through the entire set of notes over there. You want to go through the Funky Junk example, I'll put going through the Funky Junk example there for you, and you guys can work through it yourselves. But I'm going to concentrate on sections, and I'm also going to concentrate on how to answer stuff. Are you guys comfortable with that? Is that all right? Yeah, Dila? You do? They're in that big bundle that I handed out right at the beginning. So, behind the valuations notes, you'll see it in there. Is that all right? So that's there. So guys, what they ask you to do is this. And then, guys, they say attempt question 8.1 in chapter 8 of managerial finance. Just to basically explain, that's Itembe engineering. That's the one that I've handed out to you now. But I've handed out the UNISA solution, not the solution in the textbook. It's almost identical to the board solution. The board solution is in the textbook. But Itembe is part of your UNISA pack, and I've handed it out of the UNISA pack to you. Are you guys comfortable with that? So we're going to go through question 14. Everybody happy with this? Okay. So that's there. So guys, it says this will require the following. I just want to go through it. It says memorization of the various ratios. So I just want to go through what it says in your TUT letter. So you're going to need to know the ratios per area of analysis. You have to know this per area, and they will not be provided in tests or exams. So all of the stuff you need to know. 2, a proper working knowledge and understanding of what is meant by each ratio. Okay. Other calculations, especially when compared to a benchmark such as the same ratio calculation for an earlier year, similar company or industry. And 3, interrogation of your knowledge of the aforementioned areas in order to interpret and conclude upon your analysis. Are you guys comfortable with that? Okay. So are you guys comfortable with what we need to do? So what I'm going to start off today is, it's Ember Engineering. What happens inside this question is, it covers a couple of areas. Okay, so let's look at the required. Part A. It says, analyze and discuss the profitability and working capital management of Itemba during the financial years ended 30 November 2011 and 2012. Support your answer with relevant calculations and ratios. Okay, so analyze and discuss. Communication skills, layout and structure, clarity of expression, 2 marks, 22 in total. Now, guys, I want to ask you, if they ask you for profitability and working capital management ratios, to get clarity and all of that stuff, what do you think you should actually do? Guys? Do you think you should split it between profitability and working capital management? Yes. Do you think you should calculate all of your ratios first? Or do you think you should calculate, discuss? So let's just start from an exam technique perspective. So I'm going to be giving you notes. So I'd prefer you to take out a piece of paper, and I'm going to be making some comments to you. Is that all right? So my objective with this is so that you don't foobar. Is that all right? Now, guys, tell me, profitability and working capital management, why do they normally get asked with one another? Why do they get asked together? They have bearing on one another. Let me just say that again. They have bearing on one another. If I decide to put the Dragon Lady in charge of collecting debt, it's going to impact upon my sales. If I decide to have lax credit control to encourage people to buy more, because I'm not going to be on their back to actually pay their accounts all the time, and I'm going to be a lekker oak to buy from, that might improve my sales. Does everybody understand that? So, principle number 1, guys, let's just start from an exam technique perspective, okay? I'm doing profitability and working capital management today. So that's for this hour and a half that I'm spending with you today, okay? Profitability and working capital management normally asked together. Are you guys comfortable? And why? Because they've got bearing on each other. Okay, so the way that you collect your debtors will have a bearing on how much you sell. How much stock I have has a bearing on how much I'm going to sell. Are you guys comfortable with that? So I need you to understand that the two are normally asked together and they have bearing upon one another. Are you guys comfortable? Okay, so here's the thing, guys. When you're doing ratio questions for profitability and for working capital management, my suggestion to you from an exam technique perspective is calculate all the ratios first. Is that all right? So now, you've got this thing where it says clarity of expression, layout, and structure. To me, it's better to calculate them all together because I think that everything's got a bearing on everything else. The sales amount is going to have a bearing upon gross profit. If you want to reduce gross profit, maybe your sales get bigger. Are you guys comfortable with that? Now, I know that your initial inclination whenever you're doing a question is to calculate a ratio and then write about it. Are you guys comfortable? My initial inclination is never ever to do that. I don't mind that you actually calculate all your ratios on one page and then you want to write and you leave a bit of space to write underneath it. But I think in profitability and working capital management, it's better to calculate everything before you start. Are you guys comfortable with that? Is that okay? It's got bearing upon one another, and I'm going to go through that bearing with you now. Guys, comfortable with this? And I'm going to go back to some profitability ratios. Okay? So that's principle number 1. Okay? So I calculate everything first. Okay? To me, that shows that people that they know what they're actually doing. Second principle for profitability. Okay? Do you need to put return on capital employed? Do you need to put in return on assets? Do you need to put in return on equity when you're doing profitability calculations? Are those profitability ratios or those investor ratios or what? What would you do? Would you put in ROCE, ROA, ROE? And the answer to that is yes, you need to if you're doing profitability. So I'm trying to make sure that you don't fuck up. That's why I say I want you to write down your own notes now, okay? And just as a basic, okay, I'm doing an exam technique session with you on this, okay? So number one, guys, try and calculate all the ratios first for profitability and working capital management. They have bearing upon one another. Two, okay, ROCE, ROA, ROE, you need to actually put as part of a profitability question. You will see this is a UNISA question in your pack. And yes, they calculate ROCE, they calculate ROA, and they calculate ROE as well as part of your profitability calculation. So let's not screw up. We want to put that in. If you've got lots of time to do stuff, we need to maybe do that at the end. But yes, normally in a profitability question, that's there. Are you guys comfortable with that? Principle number 3, okay, for profitability discussions. What is your inflation rate in South Africa? It's 4 to 5% at the moment. So let's call it 5%. Okay. When this board question was set, it's 6%. So when I show you the solution, you'll see that they use 6% in the solution. You need to don't update it from year to year. So inflation's at 5%. So when you analyze sales, how do you analyze your expenses and your sales in a question? What is the anticipation? If you grow by 5%, there's no real growth. If you grow by less than 5%, then you've actually contracted. If you grow by more than 5%, then there's some form of real growth that's actually attached onto something. Does that make sense, guys? Okay. So when you want to analyze something, don't sit there and say, oh, look, sales went up by 10%. You sit there and say, listen, 5% is inflation and the other 5% is real growth. This is good, this is bad, or whatever. Are you guys comfortable with this? Okay, yep. Yeah, it's assumed knowledge. You have to know. That's where CPI is. So often in questions like this, they use the term CPI, Consumer Price Index. This is how much inflation is. Are you comfortable with that? So yes, it is something you have to do. There's no choice in it. Okay. So that's the next thing that I just want to point out. The next thing, guys, I want to just point out a concept called economies of scale. Is that okay? So let's just discuss this concept of economies of scale when we're analyzing stuff. Guys, let's imagine that we all of a sudden decided to register an extra 30 guys inside this class. Okay? What would happen to the expense structure at Edge? How much would sales go up by? Lots. How much would expenses go up by? Printing cost. Are you guys comfortable with that? So printing cost would go up. Okay. So there's this concept called economies of scale, and it comes up into profitability questions. Okay. So here's how economies of scale work. Okay. If my sales go up a lot, okay, I wouldn't expect my operating expenses to go up by as much as my sales goes up. Now, certain costs are variable. So let's imagine you've got sales commission. Does everybody understand that? Sales commission will go up with sales. That's just the nature of it. But guys, as far as Edge is concerned, we would have a bit more printing cost. Would I need to hire another accounts clerk? No. Would I need to hire someone new in the print room? No. So they always comment about economies of scale. So I want you to just write down a heading, economies of scale, and you should put it into a question. And you should basically, the principle of economies of scale is, if sales go up by 20%, you would not expect your operating expenses to go up by the same amount, because you don't need to get another store. You don't need to hire another person to run the accounts. You don't need to hire another HR person. You don't need to do any of that shit. Do you guys understand that concept? Okay. On the other side, if your sales went down by 20%, you wouldn't expect your operating expenses to go down by 20% either, because I still need that accounts clerk. I don't have a choice. I need someone to do my accounts. Okay? I still need one CEO. I still need one CFO. I still need one marketing manager. Do you guys understand where I'm coming from? Does this make sense? So whenever you go into one of these questions, you need to understand economies of scale are very, very important. And they might ask you about economies of scale. So I think your initial feeling, guys, is that if sales go up by 20%, so should operating expenses. Do you understand that that's not what happens in real life? Okay. Is that cool? Okay. Guys, next principle. What happens if sales goes up? I'm carrying on with the economies of scale discussion here. If sales goes up and you sell 20% more, what would you expect to happen to your GP percentage? Would you expect your GP percentage to stay the same, go up, or go down? Why would it get a little bit better? If I buy 20% more from someone, what can I do? I can negotiate better prices. Does that make sense? So this is also an economies of scale discussion. If your sales go up by a lot, now guys, certain questions that don't go up by huge amounts. Are you guys comfortable? So this is for questions where they go up by quite a bit. You would expect your GP percentage to get a little bit better, because you would expect that you would have bigger bargaining power to negotiate better prices. Does this make sense to you guys? Okay, just kind of like trying to get into like this space. Okay. Guys comfortable? Okay. GP percentages. Let's look at GP percentage. Guys? GP percentage changing in a question. Okay. So first of all, let's just actually have a look at GP percentage. Okay. If a GP percentage goes up, is this good or bad? So maybe sit there and say GP percentages. We're busy discussing it. If they go up in a question, is that good or is that bad? Good or bad? It depends on what happens to my sales figure. Okay. If I wanted to charge 100,000 for this course, I'm sure I'd have a fantastic GP percentage. Would I have anybody in the class? Similarly, if you reduce prices, you have more people in a class, but you need to have that discussion. So guys, GP percentages as a practical thing. Okay? If they go down, normally there's concern. So basically, GP percentage, if it goes down, normally there will be some concern. Does everybody understand? But not if my sales increase by a lot. Because it's like a supply and demand situation. I've got to set that right price where I maximize my profitability. Does that make sense, guys? Similarly, if my GP goes up and I'm able to maintain sales, that's outstanding management. Does that make sense, guys? So whenever you're looking at GP percentages going up or down, to me, it's always got to be a function of sales. Okay, so you always got to compare it back to sales. If your sales has stayed basically the same and your GP percentage has gone down, you're sitting there going, "Ooh, fuck, what is it that I'm doing wrong? This is bad." Is that all right? Now, I want to just introduce this concept for the first time. If you see that the GP percentage has gone down and there's nothing in the question that has actually told you why it's going down, what do you think you should put down as a discussion point? So I don't know whether you want to just put a little block inside your little discussion now, which basically says, what happens if the question doesn't tell me why something has got better or worse? So what do you think you need to do? Now, guys, think about it. Someone's asked you to analyze something. They say, do a ratio analysis and prepare a report for me. Is that right? But something's happened and you don't know what's gone wrong. What do you think you write down inside your solution? GP percentage has gone down. This is very, very worrying. I believe a full investigation should actually be undertaken to determine the causes of the GP percentage going down, okay, immediately. Because as much as you'd like to know what's going on, if they don't give it to you in the question, what is the advice that you actually physically give someone? There's a problem. I think we need to have a look at it in more detail. Do you think you're going to get a mark for saying that? What do you think? Of course you're going to get a mark, because there's nothing else you can physically write down. Jan? You say? Not always, but generally, if you don't have anything to say, say that. Does that make sense? Because what would you do in practice? I know there's a problem. I don't know why there's a problem, but I think we need to go find out why it is a problem. Because in all the information you gave me in the background, you didn't discuss one thing about this. Okay, so maybe it's something you don't know about. Is that all right? Do you understand where I'm coming from? So there's GP percentage. Are you guys aware that GP percentage is affected by the way that you handle your debtors and by the way you handle your stock? So what I'd just like you to write down now for GP percentage is that it's affected by the way you handle your stock, and it's also affected by the way that you handle your debtors. And your selling price, etc. Okay. So let's just discuss one or two things. So what happens if your GP percentage goes down? What are the reasons for it, guys? Now, can we just do a little bit of a hypothetical here? Just imagine you walked into the paper and you went blank. Okay. GP percentage going down can be as a result of two variables. What are the two variables? Sales price going down or price going up. So what do you think we should start writing down about GP percentages? Just if you want to learn like a stock standard thing that you can actually talk about it. Okay, either my selling prices, we're not monitoring them well, or what would cause costs to go up and not be controlled? Or my purchasing department is got weaknesses in it. It's screwed up. Is that all right? Or what else? Or sales, we've deliberately kept low price to improve sales. Understand? So it's one of two things. My selling price I didn't push up, so what am I trying to do? Maybe I'm trying to push sales by keeping prices low. Or maybe my purchasing department is up to shit. They're not negotiating proper prices and discounts, and they don't operate properly. Are you guys comfortable with this? So what I'm trying to do is I'm trying to give you a little bit of an approach to which to analyze each of the individual things. Are you guys comfortable with this? Does that make sense? Are you comfortable with what I'm doing here? Because I'd rather, if you want to go calculate a GP percentage, I know that you can. Are you guys comfortable? And I'm just going to go down financials and actually just go through. So I've now done a GP percentage. Everybody comfortable with that? We're going to have expenses, guys. So maybe just put a heading down there, expenses now. Yeah. I wouldn't do that unless the question told me, personally. Okay. Guys, let's just go on to the expense side of things. So let's just do the first one, bad debts. So how do you analyze bad debts? Normally as a percentage of sales. Okay. When you do this, guys, with bad debts, what do you think you should actually do? Do you think you should compare this through to the number of days debtors and stuff like that? Do you understand why I'm saying that it's difficult to do one without the other? And there should be a little bit of integration. Now, guys, bad debts, okay, as a percentage of sales. What is the discussion point that comes off bad debts? Okay. If bad debts go up as a percentage of sales, you're sitting there going, what? Bad debtors management. Your clerk is not doing their job properly. You guys comfortable? If it's come down, what are you doing? You're managing it well. Are you guys comfortable? So don't say this is better. Sit there and say, shit, my debtors clerk is doing a good job. Is that all right? What happens if your percentage bad debts is coming down, but your days debtors is going up? Percentage, so my percentage of sales is coming down. So last year we wrote of 2% bad debts. This year we're only writing of 1% bad debts. But my days debtors were 40 last year, now they're 70. What does that mean? It means I'm not writing off my bad debts. Do you understand that there should be some sort of correlation there? Does that make sense? So if it's gone from 1.5% to 1.8%, you sit there and say, shit, credit department's not really doing their job really well. And we can see that because days debtors has gone from 55 to 65. Does that make sense, guys? Is that cool? Okay, so makes sense to you guys. If it's gone from 2% to 1% and it's gone from 40 to 70, you probably just haven't written off your bad debts. And maybe you need to look and write off bad debts inside your debtors balance. Does that make sense, guys? Is that cool? Okay, so bad debts is one of those numbers. Let's go into depreciation now. Depreciation going up or down? Let's speak about that. So depreciation going up or down? How would you discuss this? So normally what do you do with expenses? Normally you do it as a percentage increase from year to year or whatever. Or you do common size, which I'm going to discuss with you later. So let's just ignore common size for this point in time. So normally you'd sit there and say, listen, depreciation went up by 3% this year. How do you discuss depreciation? What do you do if you're discussing depreciation? Guys, again, just go down to the DOF side of things. Why would depreciation, what is the input into depreciation? How many assets I've got? If it's gone down, what does that mean? I'm not replacing assets. If it goes up, what does that mean? I've bought lots and lots of assets. And if you're not replacing assets, what do you think you need to say in the question? Oh, maybe there's some shit here. You're not replacing assets, okay? Is this going to have an impact on your business going forward? Because without replacing assets, we're going to end up in some shit. If it's going up, what happens? we investing in more assets. Okay. Are you getting the returns on it? You would expect sales to go up. So I would sit there and say, shit, we bought lots more assets, more depreciation, but our sales have gone down. This is a very, very unhealthy thing. Does that make sense, guys? So depreciation is always a function of whether you're buying assets or you're not buying assets. So if you want to start discussing depreciation, to me, that's the best way you're going to deal with depreciation. Okay? And then, guys, they might give you specific expenses. You need to make a judgment call. I've spoken to you about operating expenses and economies of scale already. So if they said selling expenses, you would expect that to be variable with sales. Is that all right? If they say fixed costs, you would expect that to go up by inflation. But even if sales were to go up, even if it went up a little bit more than inflation, you wouldn't expect it to go up by as much as sales went up, just by the nature of that economies of scale argument that I've used with you. Are you guys comfortable with this? This makes sense? Okay. So just as a general, guys, if you've got expenses, what is the normal way to deal with expenses? You do percentage increase on last year. Are you guys comfortable with that? With revenue, percentage increase on last year. GP percentage will be compare this year to last year. Are you guys comfortable with that? Makes sense. Guys, ROCE, ROA. Okay. ROE. Sorry, I'm just going to be a bit of a pain here. So I just want to discuss all three of them at the same time. Okay. So you look at those three numbers, what would you expect to see? Or don't you know what to expect to see? Oh, sorry, ROE at the bottom, sorry. What is your expectation when you look at that? Does anybody have an expectation? No? Which one of those two do you expect to see? This is what you must see. Otherwise, there's a problem. Can I just explain why? So maybe don't write yet. Don't write. Just basically watch what I'm about to do. Is that okay? Okay. So pragmatically, guys, I did this example earlier in the year. And it works on the same principle. Share capital 100, earnings 100, EPS 1 rand a share. Remember I did this. That's return on assets. And in this question, return on assets is the same as return on equity because I don't have any interest differentials or anything that I need to adjust for. How do we end up getting ROA, ROCE, ROE? Is where we start adjusting out the interest and all of that stuff. You guys comfortable with that? So if my share capital was 50 and my loan was 50, my earnings stay as 100 because 100 is equal to 100 at the top. Let's imagine this is at 10%. My interest in this question would be 5, which would give me 95. But now I've only got 50 shares, which means that my EPS has gone up to 1.90 rand a share. Are you guys comfortable? So why do you put debt into there? Guys, why do you put debt? Because I want to amplify my returns. So coming back, sorry. You expect to see this, sorry. My mistake, sorry. Do you understand why you expect to see this? Because technically, my return on assets is 10%. But I take out a loan at 6% and I generate a return of 10%. And if I'm taking out a loan at 6% and generating a return at 6%, what's going to end up happening? My percentage should go up. And if I issue preference shares at 8% and I'm generating a return of 10%, again, once I go through all of the little stages, each time I pop across and I do something, so my return should go up. Now, guys, if your question looks like this, okay, you need to get rid of that part of the step because it's not good for you. Does everybody understand? That part of it needs to be eliminated out of the equation because it's costing me too much. Okay? As a shareholder, I'm losing on the step, so I don't need that type of return anymore. Does everybody understand where I'm coming from? So on ROA, ROCE, ROE, I'm trying to just write down something about 10, 15, 20. You'd expect it to go up. That type of scenario. Guys, I've only used 3 of the terms, but you'll see that there are more than that in between. So what generally tends to happen is return on assets is everything. So here's my return over my total assets. Then what I basically do is I slowly start moving. So essentially, I tend to be at the top of an income statement. And as I slowly start moving down the income statement and eliminating interest out. So I'm saying, I'm going to take the interest out. I'm going to put the interest in, but I'm going to leave the long-term debt out of my calculation, and you slowly work down. Does that make sense? So what should happen is that because I've got debt, I should have a bigger ROE. Because I've got preference shares, I should be earning a bigger ROE. Otherwise, why am I issuing preference shares? Am I doing it to benefit the ordinary shareholders or not? Because what is your job as a management accountant? Maximize shareholder value. I.e., lend at 6, return at 20. Are you guys comfortable with this? Does this make sense to you guys? Is that okay? Okay. So that's there. Do you understand the logic? And then just one extra thing, which I always just put in, guys. Listen, if they've got a return on equity of 5%, what are you going to say in a question? What are you going to say in a question? That's shit. If you've got an ROE of 40%, you'll go, shit, that's great. Are you guys comfortable with it? No, these aren't the norms. That is what you would expect to see. If you don't see that, then you're going to sit there and say, listen, you've got a type of finance that is not, that shouldn't be there. If that makes sense. Is that all right? Okay. So guys, just in general, sit there and say, oh, look, 5% shit or 40% is great. Company's doing well. That's nice. Good return. 40% return on equity. Great. That's a lovely investment to have. Okay. Guys, comfortable? Yes, it should be the highest. Then you shouldn't have the loan. So can we just use loans as for instance? Why would return on equity go down? You taking a loan at 6% and only getting a return at 2%. That's what would cause it to go down. What happens if you take out the loan at 6% and get a return at 10%? It should get better. And that's why you're using your debt like that. Does that make sense, guys? Okay. Yeah. No, I'm just using it as a general. I'm just saying that ROA should be less than ROCE, and ROCE should be less than ROE. Are you guys comfortable? Because that's why you use the financing. You use the financing to increase your earnings per share in that example that I did with you. Are you guys comfortable with this? Okay. Next one, guys. Okay. Let's just discuss EBITDA. So let's discuss this point, EBITDA. So why would I want to actually have these ratios where they've got EBITDA? EBITDA. What does that stand for? Earnings before interest and tax and depreciation and amortization. Why is EBITDA kind of like quite popular. It's a cash flow analysis. So now, guys, do you understand in a question? Often they'll give you industry comparisons, and what are you going to have to do with the industry comparisons? It's kind of like a dead giveaway that they want you to calculate that ratio. Is that all right? So some of the ratios that you've got are EBITDA. Now, whenever you're going to discuss an EBITDA thing, it's better because I've taken all of the non-cash flow items out of it. Is that all right? So when you want to discuss this, just make sure that there's a cash flow discussion that goes along with it. I know that sounds weird, but you understand why you're using EBITDA. Why EBIT or EBITDA? EBITDA, I can look at cash flow because I don't have my depreciation in there. Okay. Guys comfortable with this? Okay. Next. Okay. I want to go into some working capital management ratios or asset management ratios. So can we start with the one that never ever gets discussed? So let's start with bank balances. Okay. So bank balances. A simple look at the bank balance will see whether it's going up or down. And are you going to be able to discuss cash flow risk from that? Guys? Yes. So please don't forget to look at bank balances. It is important to look at bank balances. Okay. If you've got this overdraft that keeps on getting bigger and bigger and bigger and bigger, that is a cause for concern. Is that all right, guys? That makes sense. So look at where the balance in the bank account has gone. The company may look like it is trading absolutely famously well, but that's not necessarily a great thing. Okay. Now, can I just discuss this concept of overtrading with you? So just listen to me, and I'm going to let you actually just write something down. Okay. Guys, okay, let me explain what happened. There's a listed company on the JSE. It rents out trucks. Let me explain how that company started. Okay. There was a bank who decided to finance a whole lot of trucking companies. And those trucking companies did really, really well. Okay. And as you're doing well, what do? You buy more trucks and you keep on going. Is that all right? You get bigger and bigger and bigger and bigger. And you never think, because you are so profitable, that the banks will ever stop lending you money. And the banks lend you, finance you using a banker's acceptance or some short-term loan. And you think that the bank absolutely adores you. And then one day, the bank calls in on a short-term loan, and there are 4 companies, trucking companies, that they foreclose on. And you can't pay back the short-term loan and you can't get finance. And then they take those 4 companies and they call in Deloitte. That's me. And we combine the 4 companies together and we create a lovely new listed company. And instead of the banks being paid back their loans, they've got this equity business that is worth probably 20 or 30 times more than their loans were worth. So, number one, if you're doing really, really well, do you think a bank might foreclose on you? The answer is yes, because they want your business. And it's worth lots to them. And please don't think that a bank will not foreclose on you if you're doing well. They will. Okay, so I just want to get that logic through to you. So let's just discuss the concept of doing really, really well. And I want to explain why you might lose your company, because I know that you think if you're doing really, really well, you're not going to lose your company. Okay. The concept is called overtrading. Is that all right? So that's what the concept's called. So I just want to go through this concept with you. I'm doing really, really well. Am I going to open up another shop? Yeah, I'm going to open up another shop. Shit, I'm doing really, really well. So when I open up another shop, what do I need to do with fixed assets? Spend lots and lots of money. Okay, what happens to my cash balance? Goes down. And I've got new customers. What's going to happen to my debtors balance? It's going to go up. And I need to buy new stock. So what's going to happen to my cash balance? It's going to go down. And my creditors balance, what's going to happen to that? Guys, they've got credit limits. Okay? So yes, they will go up, but not quite as much as you think they're going to go up by. Does that make sense to you guys? Because they'll have a credit limit. They don't want too much exposure from you. So it's like you spar, and they'll sell so much to spar before you pay your account. They're not going to go and distribute to all the spars until you paid your account for all of that stuff. They don't want too much risk. And all of this means that your cash balance goes down. And what happens when you run out of cash? Your income statement shows that you're making a shitload of profit, but what does your bank balance show? That you have this shitload of bank overdraft. And do you understand? If I'm a bank, I look at it and say, shit, you know how much I could actually sell that business for? Foreclose, take it over, go find a nice buyer, sort it out because I'm capable of doing that. I've got the money to make sure that this is actually on firm footing and make lots and lots of money from it. Are you guys comfortable with it? So guys, doing well does not mean that there's not a cash flow problem. Is that right? So can I just stop here just for 2 minutes, and can you just write something down to yourselves in your own words? How that if you grow too quickly, your debtors go up, your fixed assets go up, your stock goes up, your creditors stay not the same. They do go up a little bit. But essentially, because you're buying fixed assets, debtors, and stock, you're going to run out of cash, and you're going to go bankrupt if you grow too quickly. Okay. Okay, guys, let's just go through. So bank overdraft you're comfortable with. You're going to need to look at cash flow. Guys, happy with that? So look at bank balances and just comment on cash flow. You guys happy with that? Second scenario, guys, I need you to actually just, let's go through each of the different assets. So debtors, guys, what would you expect to see with debtors? So let's just put debtors days down. Guys? So the first thing is, I would always look at what's happened to my sales. Does everybody understand that? Because if my sales have gone up and my debtors days have gone up a little bit, maybe it means that I've got a little bit less. I'm not so. I don't have the dragon lady fighting with someone, and maybe the guys like the more relaxed atmosphere and they buy from me a little bit more. Vice versa, if the day's debtors have gone down, maybe my sales have gone down, and it's because the dragon lady intimidates the shit out of everybody, and guys don't want to buy from me anymore. Are you guys comfortable? So there is a little bit of a link. But guys, if your day's debtors have gone down, what is the normal reason for day's debtors going down? Discounts. So I give more discounts. That's something that you can do. So you need to sit there and say, investigate why it's gone down so much, looking for things like changes in discount policy. Maybe I'm giving more discounts. Why else would debtors go down? Stricter credit control. No, it's not less sales. How quickly you collect is how quickly you collect. Okay? So, dragon lady. Okay? You've got too strict credit control. Are you guys comfortable with that? Or 3, what are you going to say? Or maybe we're just managing our debtors better. Because if day's debtors goes down, you're managing it better. No, you're going to say debtors days have gone down. This is great. It's probably as a result of better credit control. Okay. If the sales are affected badly, I would go back. I would just sit there because you don't want it to go down too much. Maybe you're strangling and the guys don't want to buy from you because you're not giving them appropriate credit. Does that make sense? If days debtors is going up, what could be the reason for days debtors going up? Bad credit control is 1. Number 2, not writing off your bad debts. Do you guys understand the concept that if you don't write off your bad debts, your days debtors are going to go up? Maybe you're not actually writing off your bad debts. Or the third thing is, I've decided to relax my credit control. You can, yeah. See, that's where industry becomes so important. It's normally that comment will come with industry. Is that all right? Because it should go out in both places at the same way. But it could be poor economic conditions. People don't have money. Okay. It should also be in relation to the business. If you're running a takeaway shop, you shouldn't have debtors. Does that make sense? Okay. Next thing, guys, I want to just go into inventory now. What happens with inventory? Days go up. What happens if your inventory days are low? What would you say? Good inventory control. Okay, but just let's investigate that we're not suffering from any loss of sales due to stock out. Would that make sense? If your inventory is going down, it's good inventory control. But what's the risk of having too little inventory? Someone wants to buy something and you can't sell it to them because you've run out of stock. If your stock's gone up, guys, number of days stock, what's going to happen? Guys, I'm not writing off my damaged or obsolete stock. So if my stock's gone up in days, I need to do a search for damaged or obsolete stock. I'm not writing it off. That's one reason. Or poor stock control. Is that all right? And what's the problem if you're holding too much stock? You've got excess holding cost. Remember when I did working capital management with you, I said every rand you spend on stock is less money in your bank account. So you're paying interest on your bank overdraft. So basically the result of having too much stock means excessive holding cost to the business. That's why what's going to happen. It's not per se you're getting charged. Well, there is, guys. So too much stock means the holding cost is two components. So holding cost is component one, more warehouse space. Component two, less money in my bank account, which means I'm paying more interest. So if you want to put there with holding costs, it's those two components, holding cost. Does that make sense, guys? Okay, next thing. Okay, let's just do creditors. Oh, actually, just with stock, guys, just see what the business does. Okay? Do you understand there's a huge difference between a furniture retailer and Pick n Pay? I'm not doing liquidity now, but can I just discuss liquidity just to give you an idea? Guys, current ratio. Pick n Pay's got a current ratio of 0.16. Okay? A normal furniture store like Lewis, or I don't know what Rochester is because they're not listed, but a normal listed furniture store's got a current ratio between 5 and 6. Okay? Because the simple thing is the couch sits on the floor for a long time. Whereas with Pick n Pay, the stuff moves off the shelves quite quickly. Are you guys comfortable with it? So guys, please don't, just when you're doing like stock, just think about what you think it should be. So if it's furniture, it should be slow. If it's, okay, fresh fruits and vegetables, it should be quick. Are you guys comfortable? Beer should be reasonably quick. It's got a shelf life. Sorry. That makes sense to you. Anything that's got a short shelf life should be quick. Are you guys comfortable with that? That makes sense. Just creditors, what would you do with creditors? Can I be a little bit strange with creditors? Okay. What happens if I tell you you've got 9 days in creditors? Either you're paying too quick, unless you're taking all the discounts that are available to you, and there are nice discounts available. So like with me, I'd sit there and say, shit, paying too quick, unless you're taking discounts and those discounts are valuable. So you shouldn't have very, very low creditors. Similarly, guys, what happens if your creditors are out at 90 days? No, you're pissing off someone, essentially. If you're only paying someone 3 months after you buy something, you're pissing them off in general. Now, for Pick and Pay, people will live with it because they buy so much from you. Do you understand? But in general, in a question, 90 days is too much. So the closer you get out to 90 days, that's you pissing the shit out of someone. Are you guys comfortable with this? So it needs to be somewhere in the middle. But generally, guys, what should you try and do with your creditors? Push them out without pissing out off someone. Does that make sense? So guys, this is a funny thing. If you go from 40 to 50 days, that's probably good management. Does that make sense? But if you're going from 50 to 80, maybe not. So you need to show them that, yes, it's good to pay creditors late. Why? Because rather have the money in my own bank account. But don't piss off your suppliers, because then they're not going to supply to you anymore. Especially in a bad economic environment like we're in South Africa at the moment. Does that make sense? Is that cool? Okay. So what I'm going to do now is, this question, I'm not asking you to calculate ratios, but I'm going to put the ratios up on the board, and I'd like you to maybe have a little bit of a discussion. And guys, I've tried to be generic with this, and every question is different. Do you understand that there's certain things inside this question? So can I just give you one example? What have they told you about steel prices in this question when you read through it? What did they tell you about steel prices? They're very, very volatile. What is steel? It's trading stock. So when you're dealing with, what does trading stock impact upon in this question? Can impact upon gross profit, can impact upon days inventory. Do you think that you might want to actually have a little bit of a discussion about that aspect of stock if you're actually analyzing something? I'm just giving you an example for this question. So guys, you can't just sit there and do what I've just done. You need to read through the question and you need to bear in mind with it. Is that okay? So what I'm going to do is I'm actually going to put up some ratios, and then I'm going to ask you to think about the ratios, and then we're going to discuss them. Is that all right? Okay. So let's have a look for timber engineering. So, sorry. Let me just go along. Sorry. Sorry, just let me find the right spot. That's 8. Sorry. There we go. Okay. There's the ratios. They're calculated. So what I'm going to do is I'm going to say revenue, and I'd like you to think for a minute or two on what you would write down for revenue. Is that all right? So revenue. So let's start discussing. So what has the question told us about what to expect for revenue? What's in paragraph 3? Construction industry is in a slowdown. Yes? Under significant pressures due to the slowdown in the global thing and limited infrastructure spend. So what are you going to do? Revenue growth is 3%. Let's put what's in the question to start off with, which is what? This is perhaps expected as there's large economic slowdown and reduced infrastructure spend. How many of you would have written that down? And now let's do what you think you should do. So now let's show your dazzling insight. What would your dazzling insight be? Less than inflation, which is, should you write down what the inflation number is? Yes. Therefore, we've contracted in real terms. So this is actually bad. So a growth rate of 3% indicates a slowdown in the construction industry. That's from the question. And the growth rate is also below CPR. Target is 6% max per annum. Understand, this was a board question, and it was at 6 at that stage. Now you'd probably be putting in 5, or somewhere between 4 and 5. Do you understand with revenue, you always need to actually just compare it to real stuff? Guys, now your sales have remained a loss in real terms. So when you look at your GP percentage, just take that into account. So I'd like you now to look at your gross profit margin and think about what you're going to talk about inside gross profit margin. Okay, let's open it up. What do you think you should say about this? Has it got better or worse? It's worse. Do you think you should write that down? Huh? You need to write it down. You need to say, it has gotten worse. And means that the company has performed worse this year. Guys, comfortable? Should you compare it to revenue? If your revenue's gone down and your GP's gone down, what is that? That's really shit. Are you guys comfortable with that? What else? From the question, what would you say? Shit. Drop from 40 to 36. Maybe it's what? Volatility in the steel price? Maybe not. But what do you think you should do? No, the solution is here. I'll give it to you when you're finished. It's always better to creatively look at something without looking at the solution next to you. So maybe you're supposed to know stuff. Maybe. Okay. Anybody think of economies of scale? In real terms, what's happened? Have we got real growth or have we got real contraction? Real contraction. So what would you expect your GP percentage if there's real contraction? Economies of scale means that your GP should naturally go down a little bit because you're not getting those bulk buying discounts or that type of shit. Does that make sense, guys? I'm buying less. I don't get as good a price anymore. Does that make sense? So let's have a look here, guys. It says the decline from 40.1% to 36.5% is a concern given the limited revenue growth. As I've said to you, please, when you do GP, just have a look at compared to revenue growth. You may well have made a decision to reduce a price so that you could make your revenue much, much bigger. So sometimes you're going to sit there and say, look, it dropped by 2%, but my sales went up by 20%. Obviously, customers like the lower prices. When it goes down and sales is contracting in real terms, that's when there's problems, like in this question. Are you guys comfortable? 2, the reasons for declining margins needs to be investigated as a matter of urgency. Again, you can get a mark for saying, shit, I don't know what to do, but shit, we better look at this, otherwise we're going to be in deep, deep shit. There's a possibility steel price volatility played a role. And then the last one, declining GP margin due to lack of economies of scale. You can always put economies of scale into a GP question. Always. 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 Economies of scale works with that. Even in your bloody mergers questions, they've always got economies of scale in your mergers questions. Because one of the reasons for doing it is economies of scale. I combine the two companies together, better purchasing prices. I do not need to spend as much on marketing. Okay? I do not need to spend as much on distribution. Do you guys understand where I'm coming from? Okay? I will save on my personnel because I don't need as many personnel to actually do this. I can get rid of all of the senior staff at the other organization and save those costs. There's always economies of scale whenever you go two things together. Same principle for ratios. I go bigger, my costs don't go up as much. I go smaller, my costs should be worse. Does this make sense, guys, with economies of scale? Okay. Next one, bad debts as a percentage of revenue. Okay, guys, so this was only a one marker. What do you think the one mark says? It's increased, no mark for that. Because you don't get for saying it's got increased, which means what? What happens if the bad debts are getting worse? Means more people are defaulting on paying me. And what could be a cause of that? Because we're in a really shit economy and the construction industry as a whole is in a downturn. Guys aren't paying me. You can't just say it's got worse. You need to say, listen, it's because my creditors aren't paying me, which makes sense because of the economic downturn. Yeah. Are you guys comfortable? Please just don't say it's got worse. You need to say why. I told you you're in a downturn. You need to put that into the question. So this question I wanted to do because, guys, if it's me, okay, not Marion Roberts, Group 5 has been put into business rescue. So if I was looking for a question to actually just put in a test or an exam, I'd look at this one. Because that's exactly what is happening right at the moment with the construction sector. All of the guys are in this position at this moment, and there are two that have gone into business rescue. One's gone straight into liquidation, one of the big listed. Okay, so this is very relevant, this question. Next one, guys. Operating costs as a percentage of revenue, 11.1 and 11.6. What would you do? And also other operating costs up by 7.7%. Now, guys, operating costs as a percentage of revenue, can I just explain something to you? That you cannot comment on. Why can't you comment on it? You do the calc, but you can't comment intelligently because it's got depreciation, it's got R&D, it's got all these different costs inside it. So as a whole, it's not an easy thing to do. Does everybody understand where I'm coming from? But you can look at the individual ones. So R&D, you've gone down by 8.1%. Do you understand that operating costs as a percentage of revenue, the only thing you can say is, look, it's got better, but I can't really talk about it intelligently because it comprises 100 different expenses, and I can't really comment on 100 different expenses. Does that make sense? Okay. R&D down 8.1%. Has the question mentioned anything about R&D? Just go back and look. What's in the first line? It invests significantly in R&D. It's one of its most important things. So what do you think if it's gone down by 8.1%? What do you think you're going to need to say in the solution? It's gone down by 8.1%. So it's good or bad? It's bad. Why? Because this is one of the things that distinguishes them from other people in the industry, and you might lose some market share because you're not doing this anymore. or you might operate worse or whatever. Again, you're taking it from the question. If they mention R&D in the question, you need to use it in the solution. Guys, comfortable with this? We'll see this. Next one, guys. Depreciation down by 1.5%. What can you say about that? Guys? If your depreciation goes down, it means what? You're not replacing your assets. And if you're not replacing your assets, what happens? Is that good or bad? That's bad. And may lead to problems in asset utilization in the future. Yeah. But depreciation is always the easiest. It's up, I bought more assets. It's down, less. Okay. No, if it's going down, it means you're not replacing your assets. Because just with inflation, guys, your depreciation number should get a little bit bigger each and every single year because items cost more to replace each and every single year. So naturally, you would expect your depreciation to get a little bit bigger each year if you're maintaining the same capacity. Does everybody understand? You'd never ever expect it to go down. Because that means that an asset's got to the end of its useful life. It's no longer being depreciated, but you're still using it even though it's no longer being depreciated. Okay, EBITDA. So EBITDA to revenue, 18.8%, 22.5. What would you do with that? Why with EBITDA? Okay, guys, look at the question. Just go look at your bank balance. So do you understand when you're doing EBITDA, what do you need to do with EBITDA? Look at your bank balance. So just go to the question. Have they given you your bank balance? Guys, and that's got 0, 0, 0 on the top of it. Okay. Do you understand with EBITDA, you're looking at cash flow for that. So you need to do it. So guys, 127.5 million rand overdraft. Yo. And it's gone up from 102.8 million. First of all, should you have that big an overdraft? No, what should you be doing? Converting some of that short term into long term. And with EBITDA, guys, EBITDA's gone down and your overdraft's gone up. Do you think you should have a little bit of a chat about the link between those two items? And what does that mean? Even though I'm making a profit, I'm not necessarily generating cash. And the cash hasn't gone to replace assets because I can see it hasn't gone to replace assets because of my depreciation balance. Which means what? Cash flow is really, really shitty here. Now, guys, depreciation, do you understand? By looking at depreciation, you can make a judgment call as to whether you spend lots and lots of money on buying assets. Does that make sense? Because my depreciation percentage has gone down, I haven't spent on assets. So what happens if my overdraft is going up and I haven't replaced assets? What does that mean? My cash flow is up to shit. And I haven't given you full information here, but you can make that judgment call. Is that all right? And the reason they probably don't have long-term debt is because they can't get it. And that's why they're using their overdraft. Are you guys comfortable with that? So can I just read what the questions actually got in the solution? It says the overdraft is increased which indicates there was negative cash flow generation. Guys happy? This is supported by the decline in EBITDA. Okay. The fact that your overdraft is permanent fixture there is an increase in financial risk. Does that make sense, guys? Okay. You happy with this? Do you understand what to do with EBITDA now? Does that make sense? There's always that link through to cash flow. Come back here. Okay. Cost of interest, 10%, 10.5%. Cost rate. Let's just do inventory days, trade receivables. Will you have a look at just your asset management now? Think about what you're going to put down for asset management. Did the question say anything about inventory? Just read that paragraph. So guys, days of inventory gone up. What do you think you should say in the solution? You just regurgitate what's there in the question. Trade debtors, guys. Days debtors. $65 to $75. What are you going to say? It's got worse. 75 days is terrible, huh? Guys should be paying you somewhere around about 32, 45. And what's the reason for it being so bad? The economy is up to shit. Or I would also just go for extra stuff saying that. Maybe there's a bit of lax credit control. Okay. Indicated by, this may be reinforced by more bad debts, so we're not controlling debtors properly. Or may just be that the economy is in a shithole at this point in time. Okay. And then guys, you've got your ROA and ROE and all of that stuff. Just looking here, can I just practically just explain something to you? Guys, in the first one, you go 9.6% is your return on assets. ROE is 6.6. Does everybody see that? That means my bank overdraft in this question is at 10%. Sorry, you can actually work it out from the question that your bank overdraft's at 10%, just a matter of interest. So if I'm lending at 10 and I'm only generating a return of 6.6 for my equity, should I have the bank overdraft? No. Do you understand why the ROE has gone down? Because my return on assets is only 9.6. My debt cost is more than my cost of my return on assets, which means my ROE will automatically go down. So I'm going to first of all say, listen, 6.6% return on a company as risky as this is absolutely disgusting. So terrible, terrible, terrible. They don't do it in the UNISA solution, okay? But you should say we need to eliminate some of that debt and get self-financing in, because our debt's more expensive than our return. Are you guys comfortable with this? Is that cool? Has this given you an idea of how to actually do these two sets of things? Is that all right? Okay. So I'd say, can I just discuss now just on profitability a couple of things. So often in an exam, they might tell you what you need to calculate by giving you industry ratios. Or they might tell you what to calculate by giving you comparable numbers. Is that all right? Say, this is what the number was last year. Guys, often they'll give you a whole big smorgasbord of things. So even if they give you 20 things, you only may need to calculate 10 of them. Is that all right? So if they ask you to do profitability, but they give you a current ratio is for liquidity. It's not for profitability. Are you guys comfortable? So even though they're giving you the current ratio, doesn't mean you need to calculate it. Does everybody understand where I'm coming from? Second principle, guys. You will see that there's 10 marks for the ratios. I think there are about 16 or 17 marks available for the number crunch. So you didn't need to calculate all of that stuff. Okay, and then there's 10 marks for discussing the ratios. There are 22 points down there. Is that all right? So basically, you only need to get 1 out of every 2.2 points right to actually get full marks for this question. And this is a board question, so it is. Are you guys comfortable with this? So please don't look at that and say, oh, shit. I mean, I don't know whether I could do all of that. Guys, at the end of the day, there's always like a little bit of padding inside these questions. It's not going to be like only, if they say only calculate these 5 ratios and comment on them, then obviously, but normally in a post-grad environment, that's not what happens. They sit there and say, you're out in industry, the oak gives you this, and he says, tell me, what do you think? Okay, these are the industry things that I've got just to help us along. Even if there's no industry thing, you might still want to calculate a ratio. Is that okay? Just one thing with profitability that I just want to add on. What is a common size financial statement? What is a common size financial statement? Yeah. So you make your sales 100, and everything lower down, so your cost of sales will be 52, which means your GP is 48, which means your depreciation is 5. Which means that your selling expenses are 6. And you compare on a common size basis just to see where something's gone. Okay? It's always incredibly, incredibly difficult to determine when to do a common size set of financials. Like in this question, I would have seriously contemplated doing a common size set of financial statements. But it's not on the mark plan itself. So, but I just want you to be aware that for profitability, sometimes you need to do common size financial statements. Is that all right? So it's, yeah. Yeah. See, I'd be much more interested in knowing how much my depreciation's gone up by, and how much my R&D's gone up by, and how much my operating expenses have gone up by, how much my salaries costs have gone up by, etc., rather than doing a common size one. But there are questions where there are common size financial statements. And unfortunately, I can't give you any guide, but maybe if they ask you to do common size, just so that you know what common size looks like. Is this all right? So from this perspective, are you guys comfortable? There's not a huge amount you can do on asset management here. I will do another asset management question with you next week. But just for homework, guys, will you go through that funky junk example? So it's at the back here, the solution to funky junk. Or if you've got the textbook, it's included in there. So will you try go over and will you try learn the ratios and just look at the different types of ratios? But I'd rather teach you using a theme. Is that all right? So like I'm going to go through gearing next, and I'm going to go through gearing and solvency at the same time, because good liquidity can compensate for bad solvency and vice versa. So I'll try to combine those two together. Profitability and asset management go hand in hand. How you manage your debtors and your stock impacts upon your profitability. So they often go hand in hand as well. So I'm going to try to go through the stuff with you and just show you how to approach it. Is that all right? And this one, just you get better by doing questions and actually practicing the stuff out. Is that okay? The difference between 4861 and 2 is in 4862, they'll expect more discussion and a little bit less for ratios. In 4861, there's more number crunch ratios and less on the other stuff. Guys, just one last thing. Guys, do you understand the cash flow is really, really important? It's one thing I don't think you do in enough detail in undergrad when you actually do Mac 3702. Do you understand the cash is king here, especially in this economy at the moment? So you need to actually concentrate on knowing how to do cash flow stuff properly. Cool.